Morning, everyone. Thank you for joining us on this morning's Zoom call. Before we get into our market outlook, we'll take a quick look at what we did in the month of June. Performance was good. The IG account was up another 2%. The fund of funds account was up 1.5. Continuing to build with that momentum. Both mandates are actually up about 1.5 so far this month in July. So some nice momentum there. And to talk about our continued momentum, I'll pass over to Mark. Mark, what are we seeing as far as the global economy is concerned?
Thanks, Shawn. Probably not surprisingly, we believe global activity likely bottomed in the second quarter. We expect a rebound as the impact of the monetary and fiscal policies put in place very quickly take hold. We believe, though, that the speed of the recovery will depend on whether enforced lockdowns are required upon new virus outbreaks. The COVID situation in the U.S. right now is obviously not helping businesses get back to normal operation. A cure would be very positive, but likely that's not going to happen until 2021. Taking into account the timing of the global quantitative easing, rate cuts, and market-based reflation, we expect economic acceleration to occur sometime in Q4. When we look at the March tightening in credit spreads that has occurred since April, the various monetary and fiscal packages delivered by world central banks and governments appears to have helped limit any further risks to the economy. Liquidity and credit backstops delivered to businesses have helped contain solvency risks, while income backstops provided to consumers have helped bridge the revenue gap until economic growth returns to normal. Despite the global economy faring worse during this pandemic than during the 2008-2009 financial crisis, the preemptive moves by the central banks and governments around the world should mean corporate default rates should not jump as high as in 2009 and 2010. What this means is the drop in corporate profits should be less severe than it was to the financial crisis in 2008. Where we believe the economic recovery will come from in the second half of this year will be manufacturing rather than consumer-led, as the next stimulus announcements should target infrastructure spending. On the flip side, social distancing and very tight bank lending standards should start to bite on consumer spending once government checks are spent. The best way to play this theme, therefore, is to overweight the material and industrial sectors relative to financials. The money flows to feed global cyclicals are unlikely to come from the growth sectors, though, but will likely come from other value sectors such as financials, REITs, utilities, telecoms, where COVID-19 headwinds seem to have led to more negative structural changes. Therefore, we're holding technology, adding more on materials and industrials, and focusing more on the global markets rather than strictly North America, as they still have some catch up to play. Shawn?
Yeah, perfect. Thanks, Mark. We're actually going to talk about a bit more of that stuff later on, so it's great that we introed that. Maybe switching over to Erik. Erik, where do we see the broad S&P 500 here in the next 12 months?
So yeah, thanks, Shawn. We've actually raised our target on the S&P to 3,300 recently, along with Dwyer. We're seeing the market likely to remain in a period of consolidation with increased volatility as it digests the historic gains of the COVID-19 low. I think the market's still grappling with the impact of the reacceleration recently in cases of coronavirus. And of course, in the background, it's trying to anticipate the impact of the coming U.S. election. And all the while, it's working through sort of a historic shutdown and reopening of economic activity. So there's clearly lots going on, Shawn. That said, with the combination of the incredible monetary stimulus that, as Mark had mentioned, is likely to continue for the foreseeable future, and the subsequent credit market and liquidity improvement, starting to make us more comfortable to move our targets up for the year end on all of the major benchmarks. As I mentioned on our last call, the Fed has two major mandates, and that's full employment in the U.S. And stable core inflation. So, which they stated actually they want at 2%, currently running at around 1%. So, the current dislocated level of employment inflation, we expect the negative real funds rate to remain the same for the foreseeable future, which we believe is positive for equities into the end of this year. Over you, Shawn.
Thanks, Eric. We're going to jump into some of the Q&A now. It's amazing how quick these major news networks jump from one negative to the other, but something that they've been focusing on as perhaps a negative would be the upcoming election, namely a Biden presidency. Potentially, what does that mean for equity markets? Mark, that's a question that we've been fielding from a number of clients. What are our thoughts on that one?
Yeah, it's a good question. I mean, it is concerning for many to think that there could be some changes to politics that would be negative to a market that's already been negative. But we believe easy monetary and fiscal policies remain the key drivers for the stock market and COVID-dominated headlines. It's important to remember, for us all to remember, what drives markets, and that's corporate earnings. And right now, authorities on both sides of the aisle are doing whatever it takes to ensure the stability of corporate America. Entering this correction, the U.S. economy was likely the strongest it had been in decades. Employment was at a record low. Wages were increasing. Consumer spending was ramping up. And as a result, corporate America was likely in its best shape ever. So while the nature of this pullback was warranted given the pause in economic activity, we really believe there is bipartisan support to ensure the economy and the markets regain that positive growth trend. There will be volatility surrounding early polling, but this isn't a normal election year in terms of market forces. And it's interesting to note that typically the S&P during the fourth year of a presidential cycle is positive. So that's positive for us and supports our view.
I would also highlight that JP Morgan and Goldman Sachs both last week both published reports saying that the concern over Biden presidency is probably overdone. There would actually be a good amount of stimulus in the form of infrastructure spending, higher wages, and actually reduced tensions with other countries around the world. So those would actually be net positives for the economies as a whole. What has been dominating of late as far as sectors, Mark, you touched on this a little bit in the intro, has been commodities, namely copper. What are our thoughts on that? Maybe a little bit more expansion.
There's a strong relationship between excess liquidity, industrial production, and commodity prices. So during these periods of excess liquidity, commodities typically boom. And when accounting for this relationship with a lag, the Biden recovery in commodity prices, which really started to begin in Q2, should persist into the second half of this year and 2021. China accounts for approximately 50% of global commodity consumption, and a pickup in industrial production is paramount to verify this. Fortunately, the data from China on credit growth, loan approvals, local government bond issuances are all pointing to a stronger Chinese manufacturing activity in the second half of 2020. Therefore, it's our view that value hidden in commodity prices should be unleashed over the next 18 months. And, since we live in an energy country, what about oil? Everyone's wondering about that. I think, well, what I can say for certain is that there is uncertainty over where oil prices will go over the next decade. Some believe investment in production is going to dry up and propel crude prices back to $100 a barrel. Others think the pandemic will sap demand and set up an era of cheap oil. OPEC also continues to be a key factor to future prices. And although the sector has been on its knees since the spring, the sector is now showing signs of recovery. While the pace of recovery remains uncertain in the context of COVID-19 and supply conditions continuing to tighten, OPEC's likely going to keep supply cuts in place and extend production cuts into July and potentially September. We expect, therefore, that the U.S. refineries are going to ramp up production and tap aggressively into the crude oil inventories in the second half. And assuming a continued recovery in demand, we would forecast $50 to $60 per barrel range by the end of the year and look for energy stocks to resume their advance when the seasonality turns positive in August. So a bit more positive on oil, still not where we're focusing a lot of our investments, but I think we'll start to see more positive moves over the course of the rest of the year.
Yeah. And what has seen a lot of positive news, especially of late, has been gold. A lot of talk on that. We talked about this a few months back, but now gold is broken through that $1,800 mark, hovering with new all-time records. Eric, what are we thinking there?
Yeah, we're very close. I think the high 8 years ago in 2011 was around $1,900 an ounce, Shawn. So we like gold. We're feeling very fortunate that we actually own it in our model portfolio, the income growth account. I think we have a larger weighting in that account than we've ever had in gold. I think that gold's well positioned in the current, given the current backdrop, which Mark has laid out and I mentioned on my notes. But global debt has doubled over the last 5 years, which is inflationary. We've got 0 to negative interest rates around the world, which is also positive for gold. And I think what we have for gold right now that we didn't have back in 2011 when it was peaking is we have a lot of fear, and people really just don't know whether or not we're going to get a second wave of the COVID-19. We're seeing in the U.S. cash balances in accounts higher than they've been all year. So people are putting their money in their bank accounts, not spending. So we actually see gold at over $2,000 an ounce over the next 12 months. And gold at 2,000 an ounce would mean 30 to 40% increase in a lot of the global or the gold equities that are out there from current levels. So we're bullish gold. We like it. We're happy that we own it.
Yeah, RBC is also bullish gold. I think they published a report this morning. They upped their year-end target to 2,000, so that would comfortably break through that 1,900 mark. One last thing maybe to mention just on the equities for gold as a whole. What's kind of been missed is that Q2 is actually the second highest average gold price for companies at around $1,740 an ounce. So really great for these companies that have actually delevered too since the last cycle. So really good tailwinds there. As far as maybe countries and equities as a whole, U.S. has been the best game in town for a long time. Erik, what are we thinking about maybe international equities at this point?
Yeah, so non-U.S. equities have lagged the U.S. over the last 10 years. I think it's no surprise to anybody that's on the call that if they've been in the States, they've far exceeded the performance in Europe. We do believe, though, that the June's outperformance vis-a-vis the U.S. could mark maybe a sustained trend change. First, we think that perhaps global growth momentum has turned the corner with there have been some economic surprises in Q2 internationally. Second, even with adjusting for the sector weights and mitigating for the dominance in the U.S., I believe the forward PE is still a lot lower. Shawn, maybe you can remind me of what that is. It's 6 or 6.5 times
6.4,
yeah. So, and finally, we believe that the odds are better for the U.S. dollar depreciation going forward, since contrary to like past recovery phases, which we believe that we're in right now, the Fed is not in a relative tightening mode versus other world central banks like they have been in the past. So we are starting to put some money to work internationally.
Yeah, I think our percentage is actually creeped up to around 8% as far as two mutual funds with international exposure. So we've definitely taken advantage of that, and they have definitely outperformed of late. So we're already reaping those benefits. And that is it for today's Q&A. So unless either one of you two have some closing remarks, that is it for today's call.
Yeah, I think notwithstanding the markets today, we're quite bullish going forward to the end of the year. So thanks for all of you viewers and listeners. Look forward to doing this in a month's time. Mark?
Thanks. Reiterate what you just said. Great.
Great. Thanks, guys.